Our guest suggests that you look out for takeover activity in that hot electric vehicle metal space during 2023. He's bullish on gold and uranium in the coming years. We're joined by Sid Rajeev, Head of Research at Fundamental Research Corporation. Sid, thanks very much for coming on the show. So you'd look out for takeover activity, I guess in part as big miners try to get into this energy metal space?
Exactly. Thank you for having me, Andrew. So yes, so we are bullish on EV metals. Our thesis is very simple. There were 6 million vehicles sold last year, expected to be 10 million this year, and 30 million vehicles by the end of this decade. So we feel all of the key inputs for EV batteries should do well in terms of rising demand. And when I say key inputs, these are the electrolyte is lithium, which is in an EV battery. Then the cathode or the positive side is nickel and cobalt, and the negative side is graphite. So we expect demand for all these commodities to grow with the rising demand for EVs.
Let's talk about cobalt. We have seen a run-up in cobalt this year, although your long-term forecast is not crazy bullish. In terms of price per pound, your long-term forecast is $25 a pound US versus the spot of about 23 right now.
Yeah, so across the board, our long-term forecasts are about 2x, 3x the historic average. So cobalt used to trade somewhere in the $10 to $12 a pound range. Our forecast is $25 a pound. Prices did run up last year, but we expect slower GDP growth to affect prices across the board for EV metals next year. But more than the commodity, we're more bullish on EV-focused juniors, because we feel that technology companies, car manufacturers, battery manufacturers are constantly seeking juniors focused on EV metals that can provide them long-term stable sources of supply. So we feel we're more bullish on EV-focused juniors rather than commodities for the near term, but long term, yes, we're bullish across the board.
Okay, I got mixed up there. Of course, cobalt hasn't seen such a big run up this year, relatively speaking. Lithium has. Now, tell us what caused the run up in lithium this year.
Rising demand and supply disruptions. So as economics tells us, when any commodity demand is rising and there are supply disruptions, it causes commodity prices to go up. And that's what happened to lithium. Lithium prices are up 300% in the last year. It's about $80,000 a ton. The historic average is under $10,000 a ton.
Now, so it sounds like you're not wildly bullish on lithium in the sense you see a long-term price of maybe topping out at $20,000 a ton.
Exactly. So that's more than double the historic average. As I mentioned earlier, across the board, we expect EV metal prices to decline next year. But over the longer term, we feel all 5 commodities should do well.
It sounds like, though, if you are a short-term trader, you might need to watch out for a drop in lithium in the near term.
I would say that, start focusing on companies that target these commodities, because these could be subject to M&A or acquisitions in the near term.
Yes. Let's talk about gold. You have a great chart here with the value of the above ground gold versus the M2 money supply. Now, is this the gold above ground going way back to the pharaohs and even further?
Yeah, so one of the things, gold has always been loved by investors and capital preservation. It's a great capital preservation asset. Gold is it's not really perishable. So all the above ground gold is still there. So historically, the value of above ground gold has been about 64% of the US M2 money supply. And historically, money supply and gold prices have been positively correlated. This figure is now at 57%, which means that gold is probably 11% undervalued. Another way to look at things is, if you look at the previous 2 decades before the pandemic, gold prices were up 8% and M2 money supply was up 6%. So for each percent change in money supply, we saw a 1.4% change in gold. But since the pandemic, that's not what happened. M2 money supply is up 40%, but gold is only up 20%. So if you look at these 2 models, we think that gold could hit $1,950 to $2,000 an ounce next year.
So you're not pounding the table on gold, but you reckon it'll move back to its normal relation with US money supply?
Exactly. And the catalyst would be when the US Fed turns less hawkish, most likely in Q1 or latest by Q2, and that's driven by slower GDP growth and rising unemployment. Keep in mind, 2.2 million people came off the workforce during the pandemic, and the labor participation is extremely low versus pre-pandemic. So once a significant percent of this workforce rejoins the force, we think unemployment will rise and slower GDP should prompt the Fed to turn less hawkish.
We better gallop through this. You've some other thoughts for us. Uranium, what's the prospect for uranium next year?
Uranium remains one of the cleanest and cheapest sources of energy, and there's 15% new demand coming in near term and supply disruptions. 35% of uranium is supplied by Russia, which makes the supply chain highly vulnerable. So bottom line, rising demand, vulnerable supply chain should drive prices higher.
You have an idea for us, Steppe Gold. I love that name. It always makes me think of the Scythian culture. STGO, what are they all about?
It's a junior gold producer in Mongolia. They produce about 40,000 ounces of gold. They're preparing to increase production to 100,000 ounces of gold per year. But here's a sweetener. Their cash cost is $700 an ounce, and they're trading at 1-time revenue and 2.5 times EBITDA. That's 30% below sector averages.
And then just finally, Noram Lithium, they have the Zeus project. Where is that?
They are in Nevada. Nevada is rich in lithium, but underexplored. They are 2 kilometers from Albemarle, and then they operate a lithium mine. Albemarle is the largest lithium producer in the world. We feel this region is ripe for consolidation. This project has $1.3 billion in after-tax NPV, and shares are trading at $50 million market cap.
Thank you very much indeed for joining us today, Sid.
Thank you, Andrew.
We'll have to leave it there. We could talk to him all day. That's Sid Rajeev, Head of Research at Fundamental Research Corporation. Commodities continues after this. We're going to